Hello, everyone. My name is John Harvey, and I will be your webinar moderator today. As a reminder, you can use the chat function below to ask questions, and I'll curate the questions for our speaker at the end of the presentation. It's my pleasure to introduce Brendan Ahern. He is the Chief Investment Officer at Krane Funds Advisors, KFA. He joined KFA in 2013 and was an original member of the team that launched the first set of ETF products. His prior experience includes over 10 years with Barclays Global Investors, which was subsequently BlackRock iShares. He writes a daily email called China Last Night, and I've personally been subscribed for several months, and I can say it's a great resource regarding China and emerging markets in general. Brendan is an expert in global financial markets with a particular focus on China. It's my pleasure to welcome him to our webinar today. Brendan, you can go ahead with your presentation.
All right, thank you very much, John. Okay, just gonna pull up their presentation. Okay, so let's just dive right in. We're going to talk a little bit about today an overview of what we see in terms of growth opportunities within emerging markets, and we can really use China as our lead. That Krane Shares, for those of you who aren't as familiar with our organization, is a China and emerging market focused ETF provider. We were founded over 7 years ago from Jonathan Krane, our founder and CEO, who had lived in China and saw how China was evolving away from export-driven manufacturing to more of a domestic consumption-oriented economy, and secondarily opening up the mainland markets to foreign investors for the first time. And he started down the path of creating Krane Shares. And I had spent 13 years with Barclays Global Investors and then BlackRock, and really worked to help make his vision investable. Most importantly, we're actually 50% owned by China International Capital Corp, the largest investment bank, private equity firm in China, but more importantly, the #1 research firm, having won Institutional Investor the last 9 years in a row. So ultimately, our greatest value add is providing a balanced perspective on what's happening in China. And to John's point, I write a daily research blog called ChinaLastNight.com. And then under Krane Shares, we produce our thoughts on the economy and capital markets on a bi-monthly basis. So what's happening in terms of China and emerging markets? Well, I think if you step back, something really big is happening that hasn't really garnered a lot of attention. For myself, with almost 20 years in the passive investment space, which is a little bit of a cry for help, you can't help but notice that China 10 years ago within MSCI emerging markets was 17% of the benchmark. There was only about 138 stocks 10 years ago. But if you fast forward to today, it's over 40% of MSCI emerging markets. And numerically, it's more than 50%, over 700. And it's kind of amazing to think that as much as we talk about Brazil, it's a rounding error compared to China. I mean, even South Korea, China has 7 times as many holdings. It's really remarkable, the size and scale of China within the benchmarks. And I think we're only getting started. I think in the next 3 to 5 years, China will be 50% of the benchmark, and within 10 years, it'll be over 60%. And we're big advocates of China as an asset class and EMX China investing. One of the things that happened in 2015 and 2016 was MSCI added US listed Chinese companies to their definition of China. So that brought the Alibabas and JDs into the benchmark for the first time. But a much bigger reason for the growth of China, besides the vast number of IPOs, was in 2018 and 2019, MSCI started adding Chinese A shares to their indices. So Shanghai and Shenzhen taken together are the world's second largest stock market by market cap. But it was very difficult to foreign investors to access. But John Krane, living in China, saw how they were opening up that access. The door was coming ajar. And my view was, candidly, in quitting my job to be part of building the firm was, if you're telling me the second largest stock market in the world isn't part of indices, and we can go out and own those stocks, I want to be part of that. I so believed into it. Again, I quit my job. And part of that is I believe that as the world has adopted passive investing, there's not been a lot of emphasis on index methodologies. Now we saw that recently just with S&P deciding to add Tesla to the S&P 500. But if you think about it, 3 of the 4 largest ETFs globally never owned Tesla. And similarly, I think MSCI, which dictates 15 trillion of active and passive assets, how much do we really understand their global investable market index methodology? Arguably, that index methodology is the most important book in finance ever written, because it does dictate 15 trillion. So MSCI, because China started opening up the mainland market, the Chinese A-share market, to foreign investors in 2018 and 2019, they started adding these A-shares to broader indices such as emerging markets. Now, what's interesting is how they went about it. Was they actually, in 2018, they added large cap stocks. So it was just over 200 stocks, but they only added 5% of their free float market cap. So the potential weight, they only added 5%. In 2019, because the inclusion went so well, they added 15% more. So we're up to about 20% of the potential weight is in. But very importantly is they added mid-cap stocks to MSCI's definition. And that's why there's actually 475 Chinese A-shares today, which dwarfs, more than twice as much as the Hong Kong names. But they've, again, only 20% of the potential weight. And if we skate to where the puck is going, we can see that these Chinese A-shares, the definition is MSCI China A. We know this because we've been benchmarked for 6 years ourselves to that benchmark, making it investable. But you can see those Chinese A-shares of large cap and mid caps, those 475, will someday be 20% of the benchmark on their own. That'll push Taiwan and South Korea, these other countries down. So that's part of our thesis on why we think China will become an asset class on its own. And I think there's even ways where this 50%, could go much, much higher. Now, what's happening in China? I think China is really important to be studying today because there are 2 full quarters ahead of the rest of the world that coronavirus, without question, originated in China. But because, like many Asian countries, China's had, unfortunately, several pandemics over the last 2 decades, they have a game plan. And that game plan allowed for an implementation of a very strong quarantine back in the first quarter. So now we're 2 quarters removed. And what are the lessons that have played out in China that are very likely going to play out across the globe? Now China is back to work. We have a V-shaped recovery. China will be the only country in the OECD to register positive GDP growth in 2020, just over 2%. 2021, we're looking at 8% year over year. Now, I know people will say, well, how do we know that China's back to work? Can we trust the stats? But the reality is this, my cell phone is a mobile surveillance device. And within this is the old TomTom GPS, which, if you remember, we used to Velcro it to your dashboard. But today that's in my iPhone. And that allows Google Maps and Waze to tell me where traffic is. But that same data is being sold. So when I went and bought our dog's pet food, TomTom knew I stopped. I drove into Petco, and I didn't go to Target and Walmart. And that data is being sold to hedge funds and other active managers. And the same is true in China, that the TomTom data has been telling us for months that the traffic is terrible in China, in Beijing and Shanghai. And this real-time high-frequency economic data is available. We don't need government statistics. Certainly, even just the satellite photo imagery shows that, unfortunately for China, the pollution is back as the factories get up and running again. So again, China's going through this V-shaped recovery. We're seeing the recovery broaden in terms of the underlying industries that are benefiting. And that's leading to a little bit of a cyclical stock rebound in China. It's something that's playing out almost globally on reopening hopes on vaccines. But what's interesting is, as we dive into the data a little bit, we are seeing some disparities that I think are apt to play out globally. Now China is the size of the retail sales is the size of the United States. The difference is here on the right is that in China today, your mobile phone is your mobile purse, your mobile wallet. That they've adopted mobile payments in a very dramatic fashion, and that data is all for sale. So what is the data telling us about what's happening in China? Well, it's telling us that the traditional offline stores are coming back slower. It's showing that some of the restaurants are coming back slower. Now, some element, I believe, is because the habits that were formed during China's first quarter quarantine are sticking. That the quarantine forced people to buy goods via e-commerce. With schools being closed, it forced parents to utilize online education companies. When the kids weren't studying, they were playing video games, online video games. They were communicating more via social media. They were downloading movies and TV shows. So these are all the things we're doing ourselves. And what's important is that the data shows that the habits stuck. Now, one way to prove that out is just simply looking at the Q2 earnings. So if we go back and look at what did the companies earn during the first quarter after the quarantine. So if we look at e-commerce companies in the second quarter of calendar year 2020, Alibaba generated almost 34%. Their arch rival JD.com also did very, very well. JD did almost 34%. The new up-and-comer, a company called PDD, Pinduoduo, they had a very strong quarter. And so it wasn't just the e-commerce companies, it was online gamers, online streaming companies that we saw these very, very high rates of revenue growth in the second quarter, 1 quarter removed. Now, today we're going through the third quarter calendar year. And once again, you have Alibaba. This is a $700 billion market cap company. In their calendar year, Q3, 30% revenue growth. Their arch rival, Pinduoduo, they did almost 90% revenue growth. JD, the other rival in e-commerce, almost just over 29%. Tencent, online gaming, almost 30%. So again, these trends that we're seeing that were formed in the quarantine appear to be working. And I think as you think about your investments, there is something to this growth orientation from what's happened in China. And I think that's very likely going to pan out as other countries. It'll be North Asia next, South Korea, Taiwan, but further afield, Europe, us in North America. And I think for investors, what's really, has this story, been disseminated? No, because all we read about when it comes to China is Trump and the trade war. And I think even for professional investors, it's hard to make allocations with under the guise of what's happening with some of this political rhetoric, and it certainly takes two to tango. And that's where I showed this slide of this is a technical analysis, point and figure charting. The charts don't read newspapers. Now, as much as I'm data driven, that I want to prove everything I say. A lot of times when it comes to China, we're not data driven. We read the headlines, the media, and I think potentially a lot of investors, even as professionals, we've missed these very strong returns, and that's where I become a little bit of an advocate of technical analysis, just because the charts don't read the newspapers. It simply works on price action. Now, what I think is laying the basis for part of what we're seeing in China in terms of online retail sales picking up steam versus offline, that somehow the quarantines have accelerated this adoption of technologies, I think really goes back to this, the smartphone. And what's happening in China is happening across the emerging market world. It's kind of amazing to think about. India 20 years ago had 3.5 million smartphones, and now it's 1.1 billion. Or China 85 million to 1.7 billion smartphones. Now, why that's important is because the smartphones are allowing for this leapfrogging over, say, big box retailers. It's allowing people are. I like to read a newspaper, but my kids will never read a newspaper. They did they're going to look at an iPad or a computer, but I love to open up the pages and shows I'm a dinosaur. But I think the similar type of habit formation is forming across the EM world. And again, I think the smartphone adoption is driving that. Now, I think it goes beyond e-commerce. I think it is online gaming. It's social media. It's going to be telemedicine. And a big part of that is going to be mobile payments. But again, I think this idea that consumer technology, really smartphone-driven consumer technology, is going to be a key ingredient to investors over the next several decades. And I think what that's capturing is we know that these countries are evolving. That when you go to China and certainly going to Shanghai and seeing the bund and then contrasting that with Pudong, that just shows the evolution. And at the same time, when you go into the hinterlands of China, it is a very poor country. And so, the smartphones to me allow for these emerging countries really to raise the standard of the quality of people's lives. And at the same time, elements of these countries, you could argue, are more developed than we are because of this adoption of mobile payments. And I don't think that's necessarily always captured by GDP per capita, just because these habits are happening in a very specific realm. And I think that's what we've seen in China. Some reason why we were able to have such confidence in what's happening in China is because the mobile payments tell us exactly, are people buying more on Alibaba or more on JD and Pinduoduo? Or are people downloading more NetEase games? Or are they downloading more Tencent games? Are they watching more videos on Bilibili versus YY or Hua? this adoption of mobile payments gives us great color. And we're going to talk a little bit about the Ant Group IPO, but it's amazing to think that in 2019, China did 49 trillion US of mobile payments versus 500 billion or so here in the United States. Who's the emerging market country? They're arguably far along. In fact, it's about 25% of all consumer goods in China are actually sold online. And again, I think what we've seen in China is starting to play out in other EM countries. So these are basically research reports, analysis we found from during both Korea as well as Latin America's quarantine, and it shows that something that we saw in China was in the Q1 we saw this huge uptake in monthly average users of these internet e-commerce companies, and the same thing is playing out in the broader EM world, which to me is the next step. Is this habit formation is very likely having taken place now. Time will certainly tell. Certainly, I think the Singles Day celebration in China, $70 billion in goods sold in China from Alibaba. JD reported they did over 30 billion. So it's just amazing to see again that this is happening online. And again, I think what's happened in China, this habit formation we're seeing on this slide leads me to believe it's going to stick. It's going to stick. Now, as investors in emerging markets, you have very little exposure to this trend. And I think something that we've noticed is that emerging markets, the view is out of favor. You've got a decade of underperformance. So the S&P 500, since the global financial crisis low, is up. I'm just going to pull this up. Is up 578%. MSCI Emerging Markets is up 241. The TSX I'm showing in Canadian dollars is up 217. Now I think the view would be that EM is out of favor, that the S&P 500 US equities are in favor. But I would argue the problem is when we think about why we want to invest in emerging markets, it's for this urban middle class. It's for this adoption of consumer technologies. But the benchmark is a very poor transmission vehicle for that. That what we end up with is a lot of old economy. And I think that goes back to something that John Krane really saw. He saw that the baton was being handed to new economic sectors in China. But when he looked at the time what was the largest China ETF, it was all old China. It had nothing to do with what he saw living in Shanghai. And I think that's true for broader EM. So MSCI Emerging Markets by sector, you can see it has heavy weights to financials, materials, energy, industrials, utilities. I would argue even real estate's a bit of a value sector. These are slow, low growth sectors. Now this is after a decade. So these sectors are being pushed down. That there were much higher weights 10 years ago or even 5 years ago. And so you have this higher growth orientation, but if you think about it, if half of the benchmark's been geared to slow, low growth, to me that explains the underperformance of MSCI Emerging Markets. Again, S&P is up 578, MSCI index is up 241, but half of the benchmark's been in these slow, low growth sectors. Now, I think investors have they realize this sector dysfunction. So they've tried to diminish it. You know, a few years ago, EM min-vol was all the rage, but you can see it actually went overweight, these slow. And now min-vol's being kind of kicked to the curb. Some element, I mean, having young kids, I'm a huge believer in ESG investing, but I do recognize that some element of ESG investing is simply that the benchmark diminishes this sector dysfunction. It doesn't eliminate it, but you can see it brings down some of these slow, low growth economic sectors. And again, when we look at the attribution, is the ESG outperforming from a stock selection, or is it from a sector? I believe it's from sector now. Now, the newest thing that people have said to try to diminish this sector dysfunction is, well, just eliminate the state-owned enterprises. State-owned enterprises are bad, right? But again, the state-owned enterprises are really geared to the financial sector, the energy sector, materials and industrials. And if you simply eliminate the SOEs, what you're really doing is bringing down those sectors. So just ultimately, it just begs the question, why don't we just eliminate those sectors? Now, to validate that thesis, if we think about what is a growth sector, so we'd all, of course, say technology. So since the financial crisis low, the S&P is up 478, EM is up 241, and MSCI emerging market technology is up 851. 851. So it's actually beaten the S&P 500. Now, the issue is that, and you might recall that back in September of 2018, the global industry classification system. So before you go on and buy an EM tech fund, what you have to realize is technology today is really hardware, software, and semiconductors. That they changed the definition, that the global industry classification system was redone in 2018, and they kind of pulled real estate out of financials. But they also took stocks like Amazon and Alibaba and made them consumer discretionary. They took social media companies like Facebook and Tencent and put them in the new communication sector. So you can't go out and buy EM tech and take advantage of this. And that's something that, not to pat us at Krane Shares on the back, but we were very aware of this sector dysfunction, this issue with the global industry classification system. And so we really devised our investment approach on a bottom-up approach. And so even after these changes were done, it's not had any effect on us because we've always taken a bottom-up approach. And I think people would say, well, that's why we hire an active manager. Now, active managers are smart people. They're aware of this sector dysfunction, and they can eliminate it. Well, they can eliminate it. You can't eliminate half of the benchmark. So the active managers tend to run a barbell strategy of growth and value. And for some, I would argue they almost diversify away some of these more growth gear consumer technology plays because they have to own some financials. It's simply too big part of the benchmark. Now, what's interesting is if you simply benchmark your manager to a growth element of EM, this is public mutual funds, EM mutual funds in the United States, that you'll see that the best performing manager can't keep up with this one particular sector, and that's because they have to diversify themselves. Now, for us, we've been focused on what we saw in China. That we first listed our China internet vehicle 7 years ago, and lo and behold, we've had some nice performance, knock on wood. So when we thought about applying that thesis to broad emerging markets, I don't think investors should ever not hold an active manager in the EM space or a core EM position, because I do think value can come back, but I think what we've been focused on in this consumer technology space is creating a growth dial, and I think that diminishes some of this value orientation. And again, I think you don't want to eliminate because again, you could have a value comeback. And when we look at what's driven the performance, now that we have a 3-year track record, what's driven the performance? As we always thought it was for attribution analysis telling us, it's the sectors. It's the sectors. It's a great validation for us, but I think it's something that for all investors, something that's noteworthy. Now. The value growth disparity is gotten very wide, and that's why I would caution not eliminating that core exposure, because I think we're due for a value comeback. I think the reopening trade reminds me a lot of what happened when Trump was first elected. That you might recall, when Trump first elected, there was the view that there would be deregulation of U.S. financials. So financials started rallying very, very quickly. Now, to fund that trade, investors sold technology shares, and that trade actually played out for about 3-4 months. And I think this reopening situation is going to play out. I think you're going to, just as we're seeing a cyclical rebound in China, those cyclical stocks are going to come back, and some of those are more old economy. And I think people might have to fund some of that out of if it's the proverbial FANG or growth stocks. I just think this rubber band between value and growth has gotten very wide. At the same time, I think what we've seen in China, again, I would go back to these Q3 earnings, is this habit formation. And again, China is 2 full quarters ahead of the rest of the world. And like in poker, this is a tell. And it's telling us that these companies are coming out of the quarantine in a much stronger position. And so maybe there's going to be some opportunities to buy some of these work from home stocks that maybe at lower valuations than today. But I do think they will come back. Again, that might not be for 3 months, 6 months. It's hard to say. So it'd be amiss not to talk about Ant Group, because obviously this is a key player in not only the China consumer technology, but EM consumer technology space. I had shown that Ant Group has a duopoly with its arch rival. Tencent has WeChat as their social media platform, 1.4 billion users, and they have a mobile payment unit. But Ant Group is a little different. Ant Group started out as a trusted bridge going back to 2004, when people would buy on Alibaba's e-commerce platform. They never knew what was the packages were they going to show up. So Alibaba very smartly developed Alipay, the mobile payment unit, and it escrowed the payment until the package was delivered. Now, what was important about Alipay was it allowed them to know who was buying on time. And so Ant developed credit ratings based on who was actually paying on time. And that credit rating was very important to banks. That banks could almost outsource their due diligence to Ant Group, their Credit Sesame credit ratings. And so Ant Group then developed a facilitation of matching borrowers with the banks. And they simply clipped a coupon, and they did the same thing in asset management and in insurance. They acted as an intermediary and simply clipped a coupon. Now, starting last summer, there started to be some talk as Ant Group wanted to, start talking about going public, that the regulator felt that Ant Group had become too big to fail. That Ant Group, as we showed earlier, was about half of all mobile payments in China. But the other thing that the regulator, started, really was catching on was Ant Group was allowing the facilitation of credit growth without taking any responsibility or risk. That they simply shifted that risk and responsibility to the banks. And China regulators do watch debt levels very closely. You might remember shadow banking was a thing a few years ago, and they put it out of business, peer-to-peer lending, because of the amount of that growth. So there was talk that Ant Group was going to fall under more regulatory scrutiny. And I think the company decided to try to get the IPO up as quick as possible to avoid that. I think they played chicken with the regulator. The view for a lot of people is that, Jack Ma teed off on the regulator at this conference, and they punished him by pulling the IPO. I don't believe that at all. What I think he was doing was venting his frustration, that he knew the IPO was going to get pulled. Now, I think the regulator basically, one element of why the IPO was postponed, and I do think they will re-IPO. It might not be for 6 months to a year, but the financials of Ant Group in the IPO perspective were all backward looking. And if Ant Group was going to fall under a new regulatory regime, how much would that 17 billion of year-to-date revenue, how much of that 58% profit margin were going to come down? So imagine if Ant Group had gone public, and these new draft regulations were implemented. How much would that have impacted Ant Group's stock? Certainly a very material event. And so I think the regulators simply said, these fantastic financials in your regulatory doc are all backward looking. And you need to be able to show people how you're going to operate when you have to assume some level of responsibility and risk on the loans that you're facilitating. I actually commend the regulator. And that's not to say Ant Group isn't a great company that's done tremendous innovative things. But I do understand it from the regulator position. Now, we're headed into a Biden administration. So, how will Biden be different than the Trump administration? Well, there's I think going to be more dialogue and communication. To some degree, I do believe that Trump used China as a foil, kind of look over here. It was a distraction technique. And that's where a lot of what Trump what he would say was a lot of bark, but there wasn't necessarily a lot of bite. And that's because I think, he recognized that the US and Chinese economies are much more intertwined than most people would realize. And that, when you hurt China, you actually hurt a lot of US business interest, a lot of, so there, if you actually go back and look at a lot of things Trump said, it never really came to fruition. Now, over the next month or so, it's arguably Trump will throw the kitchen sink at this. I don't think he's going to go quietly into the night. And that could, be, create some volatility. But again, I don't think Biden will like the fact that Trump via executive order is forcing policy on him. And that's where I kind of feel like, again, there's going to be a lot of bark, but I don't think there'll be a lot of bite. One of the things that talked about is this reshoring idea. We're going to bring it all back. I don't buy into that thesis. 4 billion people live in Asia. If you were going to put a factory, would you put it in where 4 billion potential people can buy those goods? I mean, the factories, it's not just a cheap labor issue, it's the size of the market. The other reality is a lot of the manufacturing in China and even in India, you have massive environmental consequence. I don't think people want to be downwind of a coal smelter. And so I'm a bit skeptical of some of this reshoring idea. Numerically, the size of China's manufacturing employment is almost the size of the US's labor force. So unless every single one of us down here in the United States wants to work in a Chinese factory, that might be hard to do. Doesn't mean robotics and automation won't have an effect down the road. But also a lot of what's manufactured in China are low-end inputs that then go into higher value goods manufactured here in the United States or Canada, Mexico. And again, those lower end inputs tend to require a significant environmental consequence. Now, as we think about, the potential for Trump not going that silently into the night, I would always recommend that you track CNH. So CNH is China's currency that trades during US hours. CNY is, onshore renminbi during China hours, but CNH trades here during North America trading hours. And stocks will react very quickly. Some of this is because of rising high frequency trading, statistical arb. And I can move a stock. If I sell stock, just selling 100 shares, it ticks down. The currency market is much, much harder to move. It's much, much deeper. And a lot of times when these headlines come up, Trump's going to delist US listed Chinese companies. Equities will react. But it's always interesting to see, does CNH react? And a lot of these headlines, they might emotionally shake out kind of weak hands. But for some, I think they provide great buying opportunities. So track CNH. It's a great indicator of whether or not a headline or political rhetoric or tweet has any economic consequence behind it. It doesn't mean it won't move stocks, but again, that could provide. There's a number of positive catalysts coming. DD, actually another company called Kuaishou is going to be coming public in Hong Kong, another kind of consumer technology play. But a lot happening in China and the EM world. And I think for us here at Krane Shares, we endeavor to earn the trust of investors. Now we want to provide a balanced perspective of what's happening in terms of the economy and capital markets, Again, I write a daily blog called China Last Night that John very generously mentioned. But my colleague, Julian Daniels, is certainly always available if there's any follow-up questions. But certainly, willing to jump in and answer any questions, John, if there are any.
Yeah, we've got a couple that have come through the chat here. So thanks a lot for the wonderful presentation, very insightful. So one of the questions I have is the difference between the value growth disparity of EM and DM. If we look at a chart of emerging markets versus developed markets value versus growth, they kind of look the same. But are there any specific drivers that make the divergence different in EM relative to developed markets?
So I'll just bring this back up. So I think if you put yourself in the shoes of a portfolio manager, what would you rather own? Petro China or Alibaba? Would you rather own Petrobras or PagSeguro, which is like a mobile payment company? I think a lot of active managers, a lot of investors, we gravitate to these growth names. And I think what's different in EM, the thing that I'm curious is I understand how a steeper yield curve could take the wind out of US tech, out of US FANG. But when I look at other EM countries, I don't necessarily, I see, in a lot of cases, very flat yield curves. Particularly China, very flat curve. China's not cut interest rates. Some EM countries obviously have. So I think what's different in EM is again, I think you are getting a cyclical rebound as the recovery economically broadens, and that should lift all tides. But I think what will be very interesting is if you do have a steepening of the U.S. yield curve and the tech FANG, can these EM countries will they also can they not can they decouple? No, this has happened. It almost never happens. That beta is beta, and if beta comes down, it's coming down. But I do think that there's an argument that if the yield curves aren't steepening, maybe they should decouple. I just think the value growth rubber band's gotten so wide that the reopening trade from vaccine, you got to fund it, and that funding has to come from somewhere, and that's where it really does remind me of the financial tech divergence when Trump first got elected. And it did last. But again, I would go back to what we've seen in China would show that these habits clearly stuck. And I think that will play out globally.
Yeah, so I guess in short, the online spending trend is not turning around anytime soon. So it brings me to another question. On slide 4, you're talking about the A-share inclusion timeline, the MSCI Emerging Market Index. I'm just curious, how long do you think it'll take MSCI to have that full 20% A-share allocation to the index?
So MSCI never provided a timeline for the full inclusion. MSCI has said that 3 issues are preventing full inclusion. There's no MSCI China A futures. The Hong Kong and mainland China stock market calendars are different. And China trades T+0. It's a no-fail, where the rest of the world is on T+2. Now, why is T? From a China perspective, they say, "Hey, we're faster. That's better." But where it's a problem is for passive investors, that if I run a passive EM strategy or all country world strategy to fund, how do I fund China? How do I raise, how do I raise if I need to sell Europe to fund China, and in Europe's T+2, I can't track my bench.
So basically without futures or faster settlement, which they don't have, there's going to be that 2-day lag of exposure that that's a passive manager's nightmare.
Exactly. Now what passive managers have done is they've gone to their brokers and said, you need to fill, I'm your best client, or among your best clients, you're going to give me the cash to fund that trade. That I'm good for it, and you can ask for a shorter cycle on that European trade, but you got to have that cash on T-day, on trade date for China. Now, what I think the brokers would say, we love you, but if this trade gets bigger and bigger, we have to allocate more and more capital. And there's a cost to that capital. There's regulatory constraints. So the T+0 is the one issue that is a little bit harder, to find, how they're going to figure out a way around that.
Yeah. And so is 20%, is the 20% full A-share weight less than 5 years out or greater than 5 years out?
I think it's around 5 years. I think 3 to 5 years is where China does move fast. I think that's one of something that we've seen is that they evolve and move quickly from a reforms. We work in finance, so we're biased because they've done so much in this area. But I think there's other things that can happen. A is that you have a growing capital markets in China, both Hong Kong as well as the mainland. So I think these numbers are underestimated. The other thing is MSCI Hong Kong, which is less than 50 stocks, but Hong Kong Stock Exchange, AIA Insurance, some of the Macau gaming stocks, and some property developers is part of developed markets. And as China and Hong Kong financially become more aligned, does Hong Kong get put into MSCI China? Now, those 50, not quite 50 stocks have about $500 billion versus I think it's about $3 trillion for MSCI China, but that's you're talking about in EM, that's 10% more China.
Yeah, so I guess it's safe to say the proposed weights now will likely be somewhat different in 3 to 5 years when we get to what could be a full inclusion. Moving on to a question, I want to talk about Alibaba versus Amazon. What do you think are the main growth drivers that are not priced in by the market yet for Alibaba, and would that give it an edge on Amazon in terms of future growth opportunities?
Well, I'm not anti-Amazon. I think what we believe, I think the core driver of the space as a whole would be that back in 1980, 20% of China lived in cities, and today it's closer to 60%. The goal over the next 2 decades will be to get that up to around 75%, which means a few 100 million more people have to move into cities. When you move out of a rural, high poverty area, a farming-based economy into a city, you get proper housing. What comes with an apartment building? Running water, proper sanitation, heat, electricity. But cities also allow you to become educated. And I think that tailwind is underestimated in China, that this urban middle class, the Brookings Institute just did a report. They put China's urban middle class spending at 7 trillion annually versus 4 trillion in the US. So I think that, China, will, has this tailwind, this macro tailwind. The case of Amazon, the upside is that the ups, I mentioned that 25% of all consumer goods are done online. I think it's about 10% here in the US. Alibaba Singles Day did 70 billion of gross merchandise. That's 10 times what Cyber Monday was last year. So there's upside for Shopify and a lot of these Wayfair. I think that is upside, and I think the issue for all of there might be regulatory issue. I think in Alibaba, candidly, in the short run, I think Alibaba is Jack Ma's in a little bit of the regulatory doghouse, and I think if anything, that's maybe if you have a very long time horizon, it's a great opportunity today. But I think the PDDs and JDs and Vshaped, which is a small, on the e-commerce side, some of those companies might be a little bit advantaged because of what's happened around Ant Group, where they tried to push this through before the new draft regulations came out. And at the same time, I do believe that it shows some benefit of the diversified basket approach, though that's self-serving and highly biased.
Yeah. Well, thanks so much, Brendan. In the interest of time, unfortunately, we have to close it there. But I want to thank you once again for the insightful presentation, and thank you to Krane Shares for giving it to us today. And just a reminder, everyone, this webinar will be recorded and on the CFA Ottawa website and YouTube channel. All right, thanks again, everyone, for attending.
Thank you. Thank you, John. Thank you, Julie.